and welcome to the 100th episode of Property Matters, supported by Fairview International Property Consultancy and auctionproperty.co.uk. You can find our weekly property show live every Sunday on our website, propertymatterstv.co.uk, or by searching Property Matters TV in either YouTube or Facebook. Whenever or wherever you're enjoying the show, please get in touch and leave your comments in the comments section below. And if you'd like to email us, as always, it's hello@propertymatterstv.co.uk. Property Matters is also available as a podcast from your favourite podcast platforms, wherever you get your podcasts, at Monday morning, 10 a.m, following the Sunday broadcast. And as this is our 100th show today, we've got something rather special for you. Not just our property expert, Joe Joshi, of course, although that would be more than sufficient. We have also Bob Singh and Guy Charrison as well. Gentlemen, welcome.
Good morning, Paul. Lovely to see you. Nice to see you, Joe.
Good morning. Yeah, nice to see everybody. Thank you for joining us. 100th episode. It's quite shocking, really, to think that we got to that. I feel like I'm playing cricket and I've got a century going on here. Yeah, I mean, we started this whole idea in lockdown, thinking how we're going to get there, what we're going to do, how we're going to communicate, and it's kind of grown its own legs, and thank you for the support for both Guy and Bob. We do disturb both of them in different parts of the world, and certainly Bob is often disturbed at short notice to have an input on the financial side of things, because obviously being part of advice or as they call it, some sort of investment discussion, we need to make sure Bob is available for that, because the Financial Conduct Authority might come down on us and say to us, "Oi, you don't know what you're talking about." So hence Bob is always on call, and Guy from a distance with his world of experience as an auctioneer and of course a surveyor, and on top of all of that, he's got his own specialities in long-term rental, long-term purchases of investment of freeholds, which I'm sure he'll elaborate a bit more on. And Paul, thank you for, of course, making it happen. 100th episode. That means that you've had to get up every Sunday morning 100, times and listen to or make me gabble away for this, that, the other. So, as I say, no pain, no gain. But thank you very much, and thanks to all our viewers and listeners on podcast. Now, we've gone all pretty technical since we started, and I'm sure Paul will have some little surprises for us. But we're now podcast available. We have our own website. Pretty scary stuff.
I've actually got a little bit of the first episode for us, Joe. Here, look, here we are. This is our first ever show.
Yeah, looking slender there, Paul.
Yes. Well, as you'll see in a second, you've gone the other way. You see, you've actually lost a lot of weight. I've just put it all on, but you will appear in a moment on our very first show. So there we go. You're just coming in now. There we are. That's Joe of October 2020. So I think that's more than enough of watching all of that. But that was our first show. And but actually thinking about it, so we're talking about October 2020. Bob, just give us your thoughts on how the property market has changed in that nearly 2 years.
I think the housing market is never ever static. Something's always happening, which is what makes it so exciting to be a part of. Last 2 years have seen many changes. We've seen the stamp duty concessions that came in. That really boosted the market because everybody took advantage of saving, certainly in our neck of the woods, £15,000 extra on stamp duty bills. So the buy-to-let market really kept the market going. But obviously the recent interest rate hikes have actually put the brakes on a little bit. People are now thinking twice about entering the market. Now it's becoming not a buyer's market, not a seller's market, but now a buyer's market, because people are thinking twice about what they pay for it. But yeah, it's changing all the time. So it's very exciting for us. It keeps us on our toes all the time, and it's good.
Well, I was going to tell you that they don't pay too much attention, but quite interesting is watching both markets, the UK market and the US market. Obviously, I'm actively involved in the UK market, although I
Certainly been a
live in the
busy
US.
time for you, that's for sure.
It's both been
Guy,
much the
what's the
same.
perception over in the States, or do
during
they not
the
really pay much
pandemic
attention
times,
outside
the
of their own
market
borders?
was exceptionally busy. A lot of people moving out of towns and cities. That seems to be more of perhaps a feature in the US. A lot of people moved out in their numbers. People moved out of New York, for example. It's something like 200,000. It's quite extraordinary. But the markets have been very strong in good, what we would call good provincial type towns. You sort of what Americans might call university towns, etc.
So let's just take a look at our first discussion point for this 100th episode. The predicted recession will be unlike the 2008 crash. So mortgage brokers will need to assess their finances and lean on available support to make it through the projected recession at the end of the year. But the wider circumstances are markedly different from the 2008 crash. So the situation in 2022 is almost the reverse of 2008, as lenders are well capitalized these days, but certainly households and companies are very exposed. Also, the downturn will be much shallower and shorter than 2008. That's generally the feeling that many experts have. Bob, would you agree and suggest that maybe it is going to be different to 2008 this time?
Well, one would hope so and pray so, because we don't really want another deep recession, because that will be quite damaging for the whole country as a whole. Now, we've had one negative quarter of GDP, we're expecting another. So technically, yes, we will be entering a recession. But the stark differences between 2008 and now are that, there's a lot of positive factors. There's no credit crunch going on. Banks have, capitalized very, very well after the last crash. The Bank of England made them, boost up their capital reserve so that if there was ever another run, they would have enough liquid capital available to sustain themselves. So that's good. The banks are now also lower risk in that they've hived off their high risk activities into different entities. So if that fails, it doesn't bring down the retail operation as well. So that's good as well. But interest rates are now, well, they were very, very low comparatively to the 2008. But now we are seeing significant rises every month, really. And if they keep on going up, then the rates that we are paying now will be pretty much the same that we were paying back in 2008. But property is still very much short supply. There's a strong demand for it still. The affordability is still there to a degree, and the appetite is still there as well. But I think there will be a slowdown. It could be a recession. It could lead to minor price falls, particularly where the estate agents have overvalued the property anyway at outset. So we'll see a correction in that format. But yeah, I think we're in a better place to weather this storm as long as this war doesn't continue for much longer.
Yes, the institutions seem to be well set for this, Joe, don't they? But the trouble is that we're coming into a period of massively increased living costs, but at the same time, record levels of personal debt on a national basis.
Yeah, I mean, the most unusual situation that's now happened, as I describe it, as a cocktail. We've got too many little mixtures going on to create what I think will be a slowdown, or in my words, going into neutral from drive for a while until such time as we gather pace again. And that is that, you've got obviously interest rates are sort of creeping up a little bit. But I think the biggest shocker, which we've never really had before and never really allowed or counted for, because it's just one of those direct debits that kind of goes out and you don't actually stop and think about it, are your electric, your gas, utilities, your rates, all the others that have just all of a sudden started to shop. So the cost of a month has gone up, not just because there's an increase perhaps in your mortgage rate, but of course there is now massive increases in the utilities. And to some household, that's not just £100 or £50. It's actually working out to be £400 or £500 a month going out because the other costs that have now added. So that is probably the unusual part. Had it been just the interest rate on the bank, I think we would have been quite safe in that view, because most people are still loving the property aspect of it, and there's a great shortage of good stuff, and so that keeps the demand pented up to a point where the buyers are still. We're not quite at a buyer's market, but it's coming that way on the basis that, even though sellers are not coming to the market as much as they want, they are having to maybe readjust their expectations for what they might have got in the last couple of years. So there are changes, but I think we got a lot of changes in the next couple of years anyway that will happen before we start to settle down, and primarily that's due to things that we didn't plan for. The Ukraine war is gone on longer already than we probably all thought, and it's possible it could go on. And then you got China and Taiwan, sort of stirring each other up a little bit, and those things will start to dwell. But the good thing about the UK, as far as I'm concerned, is we're an island, and we have a restricted amount of development, so we can either go up or go down. Very rarely can you go out. Supply and demand is there. There's more people at Calais still waiting to come to the UK, and there's nobody at Dover looking forward to going to France. So as far as I'm concerned, we'll always have that supply and demand factor that will allow people to still want to invest. Whether it's a bad time for landlords or whether it's a bad time for sellers, people will always want to buy and sell and rent in the UK.
Guy, some interesting comments from the Governor of the Bank of England. He said that it was the prospect of recession is likely, and as Bob alluded to, you only got to have a couple of negative growth quarters, and then you're in a recession. But it's interesting what he said is that he doesn't think that people will be willing to take as much caution as he is. He said the shame of it is that things have come around quite quickly from the last recession. We've had Brexit referendum in 2016, which took years to clear up. Then the pandemic, which was only shifted with the stamp duty holiday. So there's been a lot of difficulties over the last 10 or 12 years. Seems like we've been through a fair amount quite recently. He's suggesting that people just don't care. They're just going to spend. Do you agree?
I think the interesting thing what you said there is, in the last dozen years, it has been so volatile. People have seen everything being volatile, and maybe they think, well, that's just the way it is. Whereas us older chaps who've seen a lot more do remember periods of more quietness. But then maybe that's just what you reflect on. But in reality, there's always change. So I think people just accept it and go with it. And I don't think they want to tighten their belts in the same way as people used to in the old days.
So, Bob, one of the things, of course, about prices coming down, if indeed they do, is that's more attractive to first-time buyers. So do you think we're going to see an influx of first-time buyers towards the end of the years? Do you think there's going to be benefits to be had?
Short answer, no. I think the government stopped the Help to Buy scheme. The 95% schemes are there, but they're quite expensive, Paul. I mean, they're approaching 4 to 5% now. So, affordability is a big issue, and first-time buyers buying their new houses will have to face higher energy bills because they'll be going into new contracts, and the bill's going to be 300-400% higher than what may have been the case last year. So I think affordability will be the biggest stumbling block for first-time buyers. They've really got to consider their costs before they go into a contract. And with Help to Buy ending, I think it's going to be a natural slowdown for that sector in the marketplace.
It's a really tricky decision to make at the moment, isn't it, Bob? I mean, you're thinking about, well, I better get on that ladder if I'm a first-time buyer, but then there might be, if we end up with prices falling or if we end up with a slowdown, there might be better deals down the line. But I guess the downside might be that we'll still have even higher interest rates at that point. I mean, would you recommend getting in now or waiting to see how the market goes?
I think it depends on your circumstances. If you have to buy, then you have to buy. Then you've got to make that move no matter what. If you can wait, yes, you could take a wait-and-see attitude and see what happens to the marketplace. But although the rate of growth is slowing down, it's still significant. It's nearly 8% last month. It was 10% the month before. Yes, that could slow down, but it's still a lot of price increases to cope with, particularly for a first-time buyer. And 1 year's worth of growth at that level can wipe out your deposit. You've got to then start again effectively. So I think if you can get on the ladder, get on the ladder. I think if you wait, I think you might miss the boat again, and you might have to wait longer before you're in a position to meet that deposit requirement or indeed the loan requirement. And there are lots of changes happening in the mortgage world which could benefit first-time buyers. As you mentioned in the previous program, the Bank of England have asked or instructed the banks not to apply the affordability calculations or the stiff calculations, which always sat in the background of any affordability calculation. So with that now having gone, the banks are free now to sort of loosen the reins a little bit in terms of lending capacity. And already one bank's come out and said they'll lend 5.5 times income as a standard. To anybody earning a certain amount of money, like 75k, they're happy to go to 5.5 times for that person. So if one bank does it, they'll all follow. So, before you know it, 5.5 times will be the norm as opposed to 4.5 times. So the banks will have to push the boat out, take that extra risk. And Guy will remember this, the old MIG days, the mortgage indemnity guarantee premium days.
Yeah, absolutely.
I think they could make a comeback because if banks are going to take more risk in lending more money to first-time buyers, they're going to want some surety or safety behind them. And that indemnity, although it's expensive and the buyer pays for it, it does allow the bank to push the boat out and lend more money than they ought to or would have done under the old rules, and just to keep the market going for now, because they can always pull back if they feel they're lending too much at 95%. Because banks can't lend all their money at that level, they have to segment their risk profile. So I think banks have to reinvent themselves. They've got to really think back and sit back and think, how can they keep the market going, work very closely with this new government, and see what can be done. Let's see what they come up with.
And the other thing is, Bob, people have to live somewhere. So if they're renting, the average rent, I think, is nearly £1,100 a month now. And, you work out what that can buy you in mortgage terms. For a lot of people, they're far better off, even with the slightly higher rates, they're better off owning something and eventually, paying it off. And 25 years' time, they own it.
It's going to be a tough couple of years, I feel. The good thing is most people are working from home, so the travel costs are a bit less. So maybe they're better placed to cope with any energy bills increases. And they've managed to save in the pandemic as well. They've not gone out so much and not, blowing their money on takeaways or restaurants. So I think people have, got a bit of a savings or a nest egg built up, which should, see them through for the next year or so at least.
Bob, you just pick up on an interesting point there that you say that people are working from home now. I'm just wondering whether you've seen the type of property first-time buyers are buying is different now. We always everyone used to start with a studio or a one-bedroom flat. But people are working from home now, particularly if there's a couple. Or if you've seen a change in that in the mortgages you're arranging.
A little bit, yeah. Obviously in London, first-time buyers can't afford freehold houses, so they've got no choice but to go for property. But we do encourage people to look outside as well. Maybe, half an hour, 45 minutes traveling distance, where they can get maybe 2 bedrooms instead of 1, or ideally a freehold house. And they do exist. And banks understand that even if you're 1 hour away traveling distance and you're only coming into London once or twice a week, that's fine. Before they used to be really, hung up about that, thinking that it's too far, for you to travel every day. You're going to get fed up, and you're going to not stay in that property for too long. But now we do have lenders that will let you buy a property pretty much anywhere in the country, even if it's 2 hours away. So lenders' attitudes are also changing, but we as advisors do encourage people to buy out if they can. But it's personal.
Do you think we're going to see the removal of the 95% LTV mortgages, Bob? Because I remember at the beginning of the pandemic, there was no 95% mortgages to be had, and everything was 90% or 80%. So do you think that's going to be one of the protective measures that the banks and building societies take?
It's always in their armory to do so. They can remove rates overnight, or facilities overnight. Or when they hit that limit, as I said before, they can't lend all their money at 95%. So if they start breaching those parameters, then yes, they can pull back, and it's their way to control their risk. Will they really want to end them? I don't think so, because first-time buyers are the lifeblood of the property business. Until we have first-time buyers entering the ladder, then they can't buy the next property, and the market doesn't move. So it's a very essential component of the property market. So banks have to be inventive, come up with new ideas. The mortgage indemnity guarantee scheme may come back. The higher multiples are coming back. So I think they'll use affordability methods to actually keep the market going. But the government isn't helping. They've stopped the Help to Buy scheme. That's not being replaced as far as we know. So unless something else is reintroduced, the first-time buyers aren't going to be happy bunnies, paying 4 or 5% on their mortgages at 95% lending.
Second story that we're looking at is the rate of home ownership. Actual lenders are concerned, Joe, because basically the 65% of people in Britain now own their own home. That's dropped from 71% 20 years ago. More concerning for lenders is the drop in the flow of new borrowers into our housing market, amongst those aged 25 to 34, falling from a peak of 61% in 1996 to less than 40% in 2016. And there's a good point there, really, because if we don't have an influx of first-time buyers at the bottom of the ladder, they won't work their way through up over the years to those big £1 million properties that hopefully one day they'll have.
Yes, absolutely. I mean, there are two aspects here, Paul. One is obviously the supply and demand of actual property. But I think the biggest area is where Bob is concerned is funding and the mortgaging, and that's become more and more challenging as time has gone on. Long are gone the days when you sort of had either multiples or joint multiples, or even for 3 or 4 people, which I know you still can, but I think they just haven't marketed that to say that more people can join a mortgage as opposed to just a person or a couple. And because that has become tougher, obviously people have probably gone towards rental more rather than the actual purchasing, which is why the numbers have come down. But that's not to say that if the facilities were made available, those numbers will creep right back up again, because the ideal thing for everybody is to buy, and that's the fundamental wish that most people have. In fact, instead of 95% mortgages, wouldn't be surprised if we actually start to see the emergence of 100% mortgages back again in some shape or form. It may be restricted to specific employment styles, doctors and dentists and all that kind of stuff, where it allows them to, especially graduates who are moving forward and getting jobs, who want to get onto the property ladder to the first run, they may actually start to come back with 100% mortgages, which were, pretty much a thing of the past 2007, 2008 crash. But prior to that, they were there, and Bob will probably, know that and maybe give a view on that. But I think there's two aspects. One is that the tougher lending criteria that are there. I mean, 5.5 times income is kind of almost unheard of, really. You think about it. I mean, Guy will probably agree with me in the sense that we're talking about 2.5 times joint 3+1 was back what the standard was. To go to 5.5 to 6% now, multiple wise, is a huge difference. Have the incomes gone up as much? I don't know. I mean, some professionally wise maybe, but generally not. But house prices are definitely going up, and they're definitely not going to stop at 8 or 10%. They might drop to 5 or 6%, but that's still 5 or 6%, more than they're probably getting a return in their bank savings. So it never goes away. It's always going to be something that people will invest in property.
Recent research by the Tony Blair Institute for Global Change argued that mortgage finance rather than house supply was the main barrier to home ownership. Be interesting to get your thoughts on this, Guy. A report proposed a system of mandatory mortgage insurance for all higher LTV products based on the model which is very similar to what Canada has. I know that the lenders are not in favour, but there is some sense in what they're suggesting, perhaps.
Yeah, obviously, just Bob touched on that earlier with the MIGs, mortgage insurance guarantee premiums. I mean, it does work if you have to have a high loan to value. I think what you've got to look at is, you've got one side, you've got the option of renting, and we've said the average rent is £1,100 a month, or you've got the opportunity of buying. And I think people still aspire to buying. Although I think it is true to say that some younger people now have the view that renting a better quality property is more attractive than buying a lesser attractive property, and perhaps in an area that they don't want. We would years ago, as first-time buyers, you would take something in a lesser area, you'd take a lower property, you'd improve it yourself, and that's the way you'd get on the ladder. And that's how we all brought up. But now, it's like the younger generation, they don't want that. They want everything straight away. So renting for a lot of them is an attractive option. I think we sometimes forget that. I think we are dinosaurs, and that we always think everyone wants to own because that's what we felt, and that's perhaps what we would encourage our own families to do, of course. But that's not the case for everybody.
I do have a solution.
Do give us give us the answer, Bob.
And if any Prime Minister's watching, I think they should listen to this very carefully. If you want to keep the property market going, introduce 95 or 100% mortgages, but for first-time buyers only, let them have interest only, even at 50% of the loan amount. That will lower their monthly payments. It will give them the affordability, and first-time buyers can enter the market with a reasonable monthly outlay, because on half of the mortgage they'll only pay interest only. And if we can put an age gap of say 35, then after 4 or 5 years they can have a deposit saved up through the equity or savings, and they can take the next mortgage under normal rules. But to entice first-time buyers, I think interest only has to make a comeback, and that's.
And Bob, you're saying that that's just on 50% of the loan. So if someone had borrowing 100, they would borrow 50% interest only, 50% repayment.
At the moment, some lenders will give interest only if there's a big equity situation in the property. If you've got 250 equity, you can have an interest only mortgage. Or if your income is 75 or 100k, you can have an interest only mortgage. But first time buyers don't have 250 equity, they don't have 100,000 income. You need to come up with something else, and I think that something else is a part and part type mortgage with a low deposit, and after 5 years, they can think about going on to a standard scheme or transfer gradually the interest only part back onto repayment as their situation improves. That way, we'll keep the market going, and it'll make a lot of first time buyers happy.
Yeah, I think it's a very good option. I wonder, it'd be interesting to look at the actual numbers. If you look at the capital repayment bit, if you were to have that as 25 years and then maybe 20 years. So because there's not a lot of difference in the payments. So if you had, I know we're trying to reduce payments, but if you could have the capital repayment part 20 years and then interest rate for the other, that would be quite a good blend. That might actually work.
Yeah, a blend could work. A lot of people do take 35, 40-year mortgages, but you're straddling them with a lot of debt. And nobody keeps their mortgage for 35, 40 years. They move typically after 5, 7 years, and the whole thing starts again. So it's one way of tackling the problem.
It's interesting, isn't it? 83% of renters are unable to raise the 5% deposit that we've been talking about, and it's hardly surprising when you think that the average 5% deposit is now £60,000, which is quite something, isn't it? And actually, what they're saying is that is the stumbling block, because in most cases, the people who haven't managed to get the 60,000 or the 5% they need, they can actually afford the monthly repayments. They're just unable to get the deposit.
Yeah. I mean, the other idea is a bond system. A third party could provide the 5% in return for a bit of a return on the equity growth. So that's another solution. You can introduce private money into the equation as well. So there's quite a few ways this new government could help, but I think they need expert guidance from our team here.
And Joe, what do you think the outcome's going to be? Let's just look at a year from now. Where are we going to be with mortgages and with the market?
I think we're going to have a little bit of a break. We're going to go into neutral for a while, purely just to get used to all these extra costs. And once we've actually got used to those and found and fathomed our way around how we're going to deal with that, I mean, it's frightening to think that October they're going to be looking at 3,500, and then again another jump in January, and then another one in April. It's quite frightening to think where the utilities, those, it's always been the darker side that we've just never bothered to look at it, because it kind of goes out in that regular standing order money in most people's things, and they just don't actually equate to it. But all of a sudden, it's right in your face. So I think there's going to be a bit of a settlement there. I don't think that the house prices, which everybody is waiting for, is going to tumble. I think we're just going to neutral for a while until we find our new ground. And I agree with Bob in terms of the new products that they've got to do, and they will. Because one thing that is for sure, all successive governments during my time anyway have only used the housing market as their yardstick to bring it up and bring it down, to beat it or not. They either raise the interest rate or they reduce it. They reduce the stamp duty or they increase it. They do something. It's always relative to the housing market, because they know that the population is driven by their investment in that. I've always said that there should be an alternative investment available for people at a certain age. They're just not interested in dealing with leaky taps. 55, 60-year-old ones, they want to go and enjoy their time. Instead, what happens is they use their pension money or their savings towards buying maybe a buy-to-let, because they think, well, A, that's got some capital growth in it. B, I might be able to get some extra money coming in every month towards my living standard. And if actually any government would listen to it, they would turn around and say that, we would provide a specific bond or a secure investment or a good return, guaranteed return for anybody at this age, so they don't need to. In fact, that will open the doors more for the first-time buyers, because the reason why the first-time buyers, I believe, suffer is because the investor comes in and invests and they can't. So they have the deposit and they have the equity to invest. The first-time buyer doesn't. And the reason why they have it is because they've got nowhere else to put their money in the first place to have that return. So it's a bit of a merry-go-round. But because it does what it does to the housing market, no one's ever changed it. But for kids in the future, I can't see how they're going to get onto the housing market unless something like this has been created for them to start to sort of think, okay, well, that's an incentive for me to get into the housing market.
Let's move on to our final story, gentlemen. And this is a kind of a broad subject, really. And I suppose the title for this would be, has the government got it in for landlords? Because we've been seeing so much recently about landlords being named and shamed, rogue landlords. There's a story here from earlier in the month where the government is saying that it's going to start naming and shaming landlords. They're even asking them to self-refer themselves for breaches of standards to the regulator of social housing. And where landlords fail to self-refer and a breach is found, they will be contacted by ministers, no less. That's what it says in this report here. And I'll just back up my case with you by the fact that this week Leeds Renters Union speaks out on rogue landlords. Talking to the BBC about you need a licence to drive a car, you need a licence to sell alcohol, you even need a licence to house dogs in a kennel. So it seems reasonable you'll need a licence to rent property to people. Does that sound reasonable to you, Guy? And has the government got it in for landlords, do you think?
Well, I think that it certainly feels like they have. All of the tax increases and the extra regulation, it just gets worse and worse and worse. But I will just say one but. In my 42 years, without question, the quality of rental stock has increased. So I think we have to give the successive government some acknowledgement for that. But no, it's not good. And of course, what's happening is now a lot of landlords, we've all seen a lot of landlords, particularly in the last 2 or 3 years, have been selling. So actually, you're reducing the stock, you're reducing the pool. Yet we've learned today that it was 65% home ownership now against the 71% in 2003. So you're reducing the stock, so that must push prices up. So that doesn't really help ultimately that doesn't help the tenant. But I think the governments want to be seen to be doing things and trying to please all the people all the time, and that's not really feasible. But I think some of the more practical ideas that Bob mentioned earlier would be better if they concentrated on those rather than trying to bash the landlords, work with them rather than against them.
I mean, there's no doubt there are some bad boys out there doing that kind of thing. But Bob, it does, or does it seem to you? Should I put it that way? Does it seem to you that this is potentially political vote winning? Because they're an easy target, landlords, aren't they?
Yeah, they have been for many, many years. I mean, what the government doesn't realise is the landlords are doing their job for them. If landlords didn't buy these buy-to-lets, how else would they manage to find housing for the people that need it? So I think they really ought to be friendly with us and give us incentives rather than punish us with punitive tax changes and things like that, and EPC deadlines and what have you. They should work with us, and so we can increase their housing stock for them, so they don't have to build as many houses as they aim to do so. I mean, they never meet their targets, so they should be encouraging landlords to buy more property so they can help them house the people that they can't house themselves.
And Joe, we're seeing reportedly lots of landlords selling up now. They've had enough. There's just no money in anymore. And the Section 28 notices that they're all issuing now to try and get people out before the law changes at the end of the year potentially. So it's not a good bill of health in terms of how the landlords feel they're being treated by the government.
Yeah, I think the landlords are being used as the scapegoat for all the issues that the successive governments have had. But as Bob says, the more they pick on them, the lesser stock they're interested in buying and keeping. And of course, it's a vicious circle, isn't it? There's less available to rent. The biggest tenant, I suppose, single tenant in the UK has got to be the local authorities, with the number of people that are either not able to get onto a property ladder, not in a position to have, or they're going to have housing association or local council authority properties that they want to rent. And majority of them, before they actually look at the landlords, most local authorities need to look in the mirror of themselves, because the majority of their own stock is pretty poor, and that's probably being kind, in the words that I could find today. I mean, some of those are just horrific that they have to live in. Yet they pick on the landlord that have good properties and good intentions, and they have probably more reasons to go and invest in them and do them. So I think my feeling has always been that we in the property market have been a good tool for any successive government to knock around and do with us as they see fit or wish to do, because either their interest rates are going to go up, either stamp duties coming down, or they're going to punish somebody somewhere along the line, and that they're all taxes of different sorts. To turn around and start to say to landlords, you've got to have a license to do it, it's just another bit of red tape. There's another bit of money that they're going to pay someone else to go and tell them off and say, well, by the way, you got a license now, you paid for your license, but we're still coming to tell you off because you haven't done this, that, and now we're going to pay. You're going to have to pay a penalty for that, for having a license, to being honest up front, to be the right thing. So it's a constant turnaround. But throughout all of that, our 100 program would not have been as successful as they are had we not had this fantastic subject to talk about week in, week out. And we had such a good following from all the people that love property. I mean, pretty much, not that dinner tables and dinner parties are the current trend perhaps since COVID, but to be probably the top 5 subject at pretty much every conversation, every table, everywhere you go, is pretty much high up in the league. I mean, we don't have to produce a number 1 single to be in the top 5 every day, and we are there all the time, without a shadow of a doubt. And I think that's an excellent thing to be part of. So I think there is always going to be something there, Paul, that people are not going to be. But I'm a firm believer that we love investment, we love property, and property is the one that everybody feels safer about. And there's things you can do to it. You can do your own thing. I've always still find the same excitement of giving somebody a set of keys when they've actually complete and they stand in there, and then this grin on their face about what they're going to change and what they're going to do and what's going to be theirs and what they're going to make out of it. It's just an amazing experience, and I'm sure Guy and both Bob have had those in their own different ways. How can you take that away? It's part of our DNA, should I say.
And as you say, Joe, it is our 100th programme, and we'd love to thank Guy and Bob for joining us as regular contributors to our show, just to make it something a little bit special for our 100th show. Gentlemen, thank you so much for your opinions and your attendance today. And as always, Joe, thank you for making it what it is week in, week out with myself, Paul Allen. So thank you ever so much for watching our 100th programme. Here's to the 200th, coming up soon.